First of all, I'm going to start this one out by wishing a happy Father's Day to all the fathers. I know some fathers out there. Ninja Dave, since the beginning, dude, this one's always for you. This is for everybody who needs to see the truth. Because I think I am convinced that I have the truth here for you. And this is actually a very special White Knuckle episode because this one, I'm going to put the nail in the coffin for you because it's too good. It's too good. It has everything to do with the federal funds rates, right? What's the favorite buzzword of financial YouTube, Twitter, internet, even, CNBC, satellite cable television, all this kind of stuff. They're like, oh, yeah, interest rates, they're going up, tighter fiscal policy, all this. This is all going to crash the markets, right? This is what, is this not what we're led to believe? Is this not what everyone's saying? Even people I thought I could trust, even people I thought had the right idea are pushing this narrative implication that is interest rates increasing will cause the market to crash farther than it's already crashed. Okay? So first consider the basic, which is they're telling you we're going lower when we've already gone down very low. On the NASDAQ, 33%. On the SPY, 24%. On the Dow Jones, 18%. Bitcoin, 75%. Right? And it's not to say that at some point we're not going to see, way lower prices in the market. But let me tell you what the biggest inverse narrative is that's going on right now. And when you understand this inverse narrative, you will see how clearly all of the basic fundamentals of playing this market game work. This is a perfect example of how it all works. One thing I'll say is I'll draw attention to the tech bubble, okay? Because that's what we're doing. We're looking at 3 series of interest rate hikes here, okay? We're starting a 4th one right here. Here's a 4th interest rate hike setup here, right? This is the federal funds rate. Now, you can look at these charts in 2 different metrics. Like some you can look at it in this metric where you're seeing it, right now, the federal funds rate is just about 1.8%. That's the number that I believe they're using on television, and Jerome Powell uses that number. But on this chart, it's measured in this metric. So it's the same chart. I've vetted the hell out of this, okay? So let's just look at these 3 lines I've got drawn here. All right. So in 1994, what was going on in equities? Well, a massive uptrend. This uptrend from 1994 into literally 2000, this was a massive uptrend, and right here was the peak of the tech boom of 2000, right here. This is where it ended. So let's just really quickly look at the NASDAQ as compared to that span of time from 1994 to 2000, right when the bubble popped for the techs. Let's go back here. So if we look at the top of the tech bubble right here on the NASDAQ, look at this. February 2000, right? That's that weekly candle, February 2000. And you look at where interest rates were doing at that point. Well, they had just stopped and they were about to start a massive, massive downtrend. So what's my first implication here? The interest rates went down when the market went down. Okay, so that's our first example of what happened between 94 and 2000 as correlated to interest rates. We see a positive correlation, right? You understand, a positive correlation. Interest rates are moving up and markets are moving up, and then they literally also started going down at the same time, right? So interest rates are uptrending right here, right into the top of that bull cycle. You have no reason to believe that market is going to turn around other than the fact that everyone's in euphoria and the news is telling you to keep buying, right? The only clue to that situation in the dot-com bubble, your only fundamental clue was that these markets are way overbought and everybody on TV is telling you to buy them. That is a massive part of it, right? Okay, so then let's look at what happened from 2004 into 2008, the top of, or 2007 here. So this one is a really, really good example, because check this out. Interest rates started coming down in June of 2007. They started coming down in June 2007, summer 2007, right? Look at that. Summer 2007, rock bottom in January 2009. Look at this, right? What were markets doing from summer 2007 to January 2009? Let's look at the S&P for this one, because we were just getting these. It's good to look at all the markets. They're basically the same, you know, on a very basic level, they're the same, but I think the S&P really, really illustrates this point beautifully, which is that, look at the S&P. It tops in October of 2007, right? Tops in October of 2007. But interest rates had already turned the corner back here in the summer of 2007, just a little ahead, you know, not a lot ahead, right? And then you have this crash, you have this sell-off, right? And then what happens? You make one more slight all-time high. By the way, interest rates are coming down here. They're already, if I'll draw this line, I'll just do the overlay. So interest rates have been coming up. Right here is when they go down, right here. See that? And then they all go down together. We go down together. And so markets had one more all-time high, right? Well, it's not an all-time high, actually. It didn't break through this high. So that's another big signal. Look, you know, this is all bear market-y stuff right here, right? Straight up. And so after interest rates had already started to come down, they brought the market down, right? So positive correlation, interest rates coming down brought the market down, right? Now let's look at our final example here. We can see this on S&P, we can see this on NASDAQ, we see this on Dow Jones. But what happened here? We had another interest rate cycle, right? We had another interest rate cycle of interest rates moving up. Now, it's really interesting where they started moving down. That's where you got to pay attention here. This is like, watch how this blows your mind, because it's so inverse of what they have you believing right now about what interest rates do. Look at this. So in 2016, end of 2015, right on the cusp of 2015, 2016, you had another rate rising right here, right? So the rates began rising in fall of 2015, right? All the way till summer of 2019. Think about this. This is the keys. Literally, rates rising from fall 2015 all the way to summer 2019. Think about what comes in spring 2020. So look at this. What the hell? What is that telling you? Think about this. Maybe rewind if this isn't clear. Interest rates were coming down, anticipating the massive sell-off that happened in markets in spring 2020. Look at this. May 2020, spring 2020 is when they bought them, just when the markets bought them. Now, you can ask yourself, did the, Federal Reserve anticipate, were they, how did they move so in lockstep with what markets are going to do? And the simple answer is, well, they manipulate markets, right? And so if they manipulate markets, look how they manipulate markets using the federal funds rate. I just showed you a positive correlation of the federal funds rate to equity markets. And right now, the media narrative is the raising of interest rates. See, we're coming into a raising cycle. We're coming into a raising interest rate cycle. The narrative is, oh, that's tighter monetary policy. That means the cost of borrow is that means that the cost to borrow is higher. That means people can't buy things because they can't afford to borrow money. That's what they're telling us on the media, right? So I'm just trying to illustrate one aspect of this basic principle, which is that you literally should do the opposite of what everybody does, right? You should do the opposite of the herd. And I'm sure all of you who are watching my channel, you watch all these other channels too probably, has literally just about everybody gone bearish. Everybody is on the bandwagon of it's only going to go lower from here. Oh, break this line in the sand, break that line in the sand, cross this line, cross that line. I know it's like that's like the thing. It's like, dude, If you make a line, the universe will cross it. That is rule number one. You can, come on, everybody, like literally. And then yet everybody out here is like, oh, you crossed my line in the sand, yo. Like, I don't know about this anymore. It's like, what? That's like so not how this works. And then you know the basic thesis of you got to do the opposite of what everybody says, but you also got to find the evidence that no one's talking about. The evidence that no one's talking about is that interest rates have a positive correlation to the markets, and if interest rates are about to raise, they're raising, then the markets are about to raise. And if we're considering that we've already had this massive sell-off, this massive correction, I mean, in the NASDAQ, this is a 33% correction. In Bitcoin, it's this, 75% correction. That's what I mean about Bitcoin is like the leveraged NASDAQ. You just get bigger downswings, bigger upswings. So the opportunity is bigger, right? On the downside. But the point is, you're coming into the bottom of this trend because interest rates right here are turning way, way up. And if you look at the speed of how interest rates have moved in the past, right now, this trend is like the fastest one we've ever seen. And so when everyone's talking about, this is the end of whatever, and then they're giving a reason that is completely false. The idea that interest rates are going to make markets crash. Who started that? Where did that come from? Why is everyone saying that? I literally, seriously, what am I missing where literally that narrative is coming? Because look at this chart. And tell me if I'm reading the chart wrong. I think the most interesting part is in 2007 and in 2019, interest rates anticipated massive sell-offs. You could literally make the argument that the interest rate dropping caused the market crash. That's what it looks like when you look at the chart, right? Because if interest rates are coming down in summer of 2007 and the market crashes in fall of 2007, right? Okay, same situation over here. Interest rates coming down in summer of 2019. Markets crash in spring of 2020. So they were even earlier on this one. They knew even farther ahead of time on this one. So if you can see those connections, what is this telling you? What is this telling you? And the fact that the media in the narrative that's being like literally drilled into everyone's heads is that this uptrend right here will cause the markets to go lower. Am I wrong? Is this not the exact narrative? This uptrend will cause markets to go lower. That's what everyone is saying. Let's talk about what people are saying about inflation, okay? Because that's basic as hell. Holy freaking crap, that's basic as hell. Has anybody talked about oil? And has anybody talked about how oil and the dollar are obviously in exact lockstep because this is the petrodollar? So they both have this strong uptrend. They're both coming up to major resistance points, already starting to put in bearish structures, and we know nothing moves in a straight line. Is anybody talking about the fact that oil might finally be selling off? Look how long it's been going up in a straight line. Nothing moves up in a straight line. The last time something like this happened in oil, look how freaking crazy it went down. The point is people are speculating on oil, and it causes these extreme moves. And that is a little bit absurd. Why are we speculating on oil? All I know, I'm not speculating on oil, but I'm telling you that if I look at this trend, it looks like it's going to freaking reverse because it's been going up in a straight line for so long, and it's coming up against a key part of resistance. And we can also see that the straight line that it's been going up on since spring of 2020, that's when interest rates were at zero. In this case, oil actually anticipated what happened. Look how early on oil anticipated the, like the COVID situation or the crash of March 2020. Oil is selling off in January 2020, right? And then it bottoms out right after. In April 2020 is when oil bottoms out. So you could make another argument that oil sort of anticipated this is a very dramatic crash. It literally crashed. The media was literally saying it crashed to zero because it literally did on the chart. That doesn't mean it actually did, but it did on the chart. So the media is like, oh, it literally crashed to zero. Oil literally crashed to zero after COVID hit, but look where it started crashing. It started crashing in December 2019. So you know what I'm saying here with a lot of this kind of stuff here? Like, I don't need to spell it out for you, but you can see what I'm talking about here. You know, like nothing is like a coincidence, right? And especially you see it on the charts when like oil is anticipating something dramatic happening in markets, right? You see this. You can also see this on the DXY. The DXY is anticipating something dramatic happening, right? Look at this huge, massive volatility, right? You have the biggest two weekly candles. I'm looking at the weekly chart right here on the DXY weekly chart. You have two massive weekly candles in a row. Yeah, you're gonna get a reversal, right? You know, this is how nothing moves in a straight line. It had already been uptrending. You can anticipate some dramatic, you know, reflection point coming after these two massive green weekly candles. And the exact same logic applies to this uptrend. This is a dramatic uptrend in one direction. You're going to get a reflection of that drama to the downside as well. And if you just look at the freaking dollar, it's got a bearish candle on it. This is a weekly candle. You know what they call those? They call those topping tails. That's a topping tail. Just like they have the bottoming tail, you know, kind of the same way. But you don't see any dramatic bottom tails as much as this. This is the most dramatic reversal candle we've seen since over here, right? So, you know what I'm saying? And the other major reversal that we're seeing is in oil. We see an even uglier reversal candle. And this is overdue, right? This is overdue. From the excess speculation, you know, this thing gets blown out of proportion. This thing has moved up in a straight line for 2 years. Over 2 years, oil's moved up in a straight line. You guys, gas prices are coming down. They're going to come down. I promise you. They are coming down. When oil comes down, and it starts to look like inflation is going away, when it starts to look like that, you better believe those markets are going to rip. And the reason we know that is because the Fed already knows that. That's why they're hiking rates. They already know what's about to happen, right? I know that doesn't make sense to you unless you've rewinded all the times I've already made this point throughout this video. But I'm going to make that point one final time here. The markets have a positive correlation to the federal funds rate. The federal funds rate has anticipated the last two major moves of the market. This one here, the federal funds rate started crashing down 6 months before the market crashed. Here, the federal funds rate started trending down and then eventually crashing down. The summer of 2019 before the spring of 2020, the federal funds rates were crashing down. So they're early and they have a positive correlation. Is that not the keys to the kingdom? And then you literally have to check the box of how bearish everybody is. Everybody is bearish. We know rule number one. We have confirmation of rule number one. And that is everybody's bearish. And I just showed you that the federal funds rate has an anticipatory positive correlation to equity markets. Why has Bitcoin crashed farther than it's ever crashed before retracements ever come in? How is that possible? Well, it's because NASDAQ's been going down the whole time. That's all. That's the only reason. That's why you don't draw lines in the sand. You don't draw lines in the sand, okay? They will get violated. You understand the greater picture. You understand the context. Everything has its place in the context. This is a woven, synchronistic masterpiece of rhythm that we're seeing when we talk about these chart inversions. And the federal funds rate is literally it's the freaking holy grail right here. That's why this is the special Father's Day episode of White Knuckle. I just showed you how the inverse is the name of the game. We're on inverse seasons, right? Inverse seasons. Everyone's telling you that the Fed funds rate has a negative correlation in the markets. Well, guess what? It has a positive correlation to the markets. So I don't know what else you want me to tell you other than if you want me to tell you, I'll tell you to buy. I don't know how low this thing's going to go. I don't freaking care. I don't even like this is literally the biggest bear fake out ever. That's what I'm saying. This is the biggest bear fake out ever. Well, maybe not ever, but kind of ever, because it's the inverse of the .com. And that was the biggest fake out to the upside ever. I'm saying this is the biggest fake out to the downside ever. Do you see what I'm saying, dude? Like, oh, you have literally, let's just look at this. You have literally 74% crash without any type of retracement coming in on Bitcoin. You can't even call this an ABC correction almost at this point, because this is a crappy B leg compared to the C leg. This isn't even the heart wrencher. Here's what I'm saying. Here's what looks like is starting to play out on this Bitcoin structure. Because if I'm anchored to the same thesis I've always been anchored to, I'm going to show you how my basic thesis has never changed. I'm still thinking about ABC corrections. We have not had the 702 retracement on Bitcoin. So look what this is. If this needs to retrace, it will retrace. The downside volatility is reflected on the upside. The original thesis of the altcoin 702 retracement is completely intact, and it is now blown to proportions that will exceed any expectation that everyone's ever had in a historic way. And look at this. So what's this ABC correction here? A could go lower. Whatever. That's approximately A where it is. It could go lower. There's B. And there will be your C heart wrencher. There will be your C heart wrencher. You see that? That's now what we looks like we're playing out here, right? And that is flawlessly aligned with what we're seeing in the NASDAQ, what we're seeing in the S&P 500. We have seen massive downside sell-off without any retracement on large time frames. None. This is bordering going down a straight line. This is getting to that point where you go down a straight line. And it might crush it harder, like compare it to what happened in 2020, right? Might crush down harder. Who knows? But it could go all the way to scare everybody down here, right? That would make sense, maybe, probably. It could violate that line. But the bigger context is like, wow, this is a slow pitch softball from the universe. And if you committed to your thesis and you see the inversions becoming clearer and clearer every day, the federal funds rate mythology inversion, right? The mythology of the federal funds rate is that it has a negative correlation to equity markets. It in the past 2 major cycles, up and down, the federal funds rate has had a positive correlation to the markets. 2000, 2007 into 2008, and then if you want to count this one, it had a positive correlation anticipation of this massive move down in March 2020. The federal funds rate anticipated this on the SPY. On the NASDAQ, the federal funds rate had already turned down the corner months ahead of time. Months ahead of time. That is very significant to really pay attention to here. And it is not the first time. Think about the fact that here they changed the rates not as far ahead of time, right? Before the crash, right? They anticipated the crash, but not as far ahead of time. And here they anticipated the crash even farther ahead of time. What am I saying? What is you go decide for yourself? Have I, and tell me, call me, message me if you need to set me straight, because this thesis is so out of whack. Like, just thinking on this level feels like I'm being gaslit. You know what I mean? Because everybody is saying that the rate hikes will cause the market to crash. Why are they saying that? Who can't see what I just showed you? Please, in the comments. We are in a new paradigm. Maybe. I don't know.